Still talking about growth in a low growth environment. And of course, when we talk about growth there, we're talking about growth in your returns from the assets that you're investing in. Our special guest for this show, and Cabot Alatalze, head of Alexander Forbes Research Institute. And of course, Quibby and Roland, as always, my sidekicks on the show tonight. So let's take a look at kind of Carl Hewlett from Argon Asset Management. He's a CIO there, talking about expect and accept low economic growth. That is a given going forward as to how to invest from here. And he talks about the role of active investment.
You know, I think the important thing here for me is he kind of goes through each of the talking points that we went through in the first half of the show. He encapsulates literally the whole issue. He says debt is a problem, demographics is a problem, adapt to a low investment return environment, minimize cost, always remember that. But then he highlights something which is quite interesting: tactical asset allocation and the importance as far as this is concerned. Just have a look quickly at the graph on your screen at the moment, and it shows you the markets, and it shows you the various quantitative easing factors, I suppose, that happen in the market since 2008. And there you can see them actually priced 1, 2, 3, all the way out. And you can see how the market literally reacts every time there's a quantitative easing that happens, or alternatively there's a bailout that happens. And I think that becomes important for me, being able to gauge and understand when to be tactical and when not to be tactical. And that, quite frankly, is active asset management, you know, down to a T. The question is, do we have the skill set? And that's something that we've been debating for a very, very long time.
Well, you've just raised a terribly important point here. Because what has driven tactical asset allocation, the point has been of fundamental factors. And you're saying that what's changing the dynamics is actually, you know, policy factors. And that's the risk on, risk off dynamic that you're having to gauge. So you're absolutely right. Do those skill sets exist? Those are very new sort of ways of looking at asset allocation returns.
But is that sustainable? We can't have bailouts for the next 50 years.
No, you can't.
Right?
And
so
it will go back to something.
We have to go back to fundamentals or some kind of normalization where markets are driven structurally or strategically rather than what the central bank.
Our markets always, I mean, you're talking about, you know, markets becoming more rational. There's always going to be that element of herd behavior.
Sure, but it's just that the dynamics, the mechanism of the markets currently are still broken, because we have to rely on these central banks to give us that sort of drug or cash injection to get us going again every time. And it's like kickstarting this car that's actually failing. And we need to get out of that. And I believe we will. It's just we don't know when.
We will go back to some sort of normalcy in that respect. But here's the bottom line. When we are in this low return environment, we cannot count on a passive strategy. Now, think about the implications there. You've got National Treasury saying, cut costs, get things down, go to passive. Whoa, how's that going to work when we don't have, you know, alpha generation at that asset allocation level?
But I think we need catalysts for the economy to also start going again. And we might be structurally in a low growth environment, but we're going to have cycles, surely, bubbles, mini bubbles, or sort of cycles that rely on higher growth, especially in different markets on a relative basis. It's all about relative investing here, right? I'm worried about the fact that we need to get the economy going again. That's the thing. And
but you know, Ronald, the interesting thing is, I mean, if you look at the American market and go back to 1929, which is really Great Depression years, 1929 there was a crash. Crash wasn't actually that bad. The real crash happened in 32. That's when the serious crash happened all the way down in the market. And the next time around, the market hit its high point is back in 1954. Now, that's a long time for a clearing out effect to happen. I mean, you've got a Second World War that happens in the middle of this. You've got Bretton Woods that happen. And that's all a clearing out effect in essence. Now, how do you do asset allocation in a scenario like that? I mean, that is really, really, really tough. And as a matter of fact, I mean, Tony Bell and Fernando Durrell, the future isn't what it used to be. Actually, you know, tries and ascertains and starts doing some of this stuff.
Okay, so let's put some of the scenarios on the table, right?
Yeah, I mean, let's have a look at those. I mean, just have a look quickly at the following table. Here, they're looking at the historical asset class real returns for 3 different macroeconomic environments. They call it a bad state, a normal state, and then a good state on the other side. And they ask the question, well, what could your annualized 5-year returns look like for some of these, for each one of these scenarios across various asset classes? And then they ask the question, what is the probability for, in this case, equities to beat inflation? And there you can see some of the probabilities at the bottom end over there. Bonds, what is the probability for beating inflation? and so forth and so forth. Now, I mean, the interesting thing is, and even though this is kind of important data, it again uses regressive data in order to paint a picture for the future. And the question is, are we using the right data set, specifically if economics are changing?
Well, except for what they've tried to do is that they've looked at two very important catalysts. Liquidity. In other words, that gets back to your policy. What's the government doing in terms of pumping money or extracting money from the system? And how do we measure that? And then the other thing that they're doing is, rather than looking at GDP, is that they're trying to get a much more granular level of looking down at economic activity. So you're looking at consumer, in their factors, they're trying to understand what is consumer behavior, what is, what's productivity in manufacturing delivering. What are some of the coal-face dynamics that are dictating what the economic health of the country are? So what they're trying to capture are factors that I think are relevant no matter what sort of environment we're in. It's got the policy side as well as the real.
I mean, we've just gone through an American debate where literally that liquidity thing was right in the foreground. People saying, well, should there be liquidity or shouldn't there be liquidity? I mean, Roland, let's get your opinion about this. I mean, do you think that's a robust way of actually looking at GDP growth? I mean, it certainly is a new way.
Well, not GDP growth.
Well, growth generally in a
market, macro environment.
Yeah.
The liquidity is the last resort. I mean, if we hadn't had this liquidity injection, who knows where we would be? So, if you read sort of work by Clifford Asness, to him, it's not about the returns necessarily or the lack of returns, but it's about the risk appetite. And there is no risk appetite currently anyway. So
and that's my question about valuations of stocks.
It comes back to confidence. In other words, are people happy to stick their head out of their shell? Are people happy to invest in houses because they're worried about the fact that they might not be employed anymore? So it's the whole kind of cycle of we've got to make sure that employment doesn't get worse, or unemployment gets worse, and then people will start feeling comfortable and start spending, and then we don't need the government to spend, we can get the economy to spend.
You can create more smaller businesses. What are your thoughts right now on the environment going forward, kind of this low growth environment, how it's going to impact equities versus bonds, and your view specifically, I suppose, on bonds, which have had a pretty good run?
I think what it suggests, and this goes back to this active-passive debate, that within the fixed interest environment, there are going to be opportunities, and they will be very variable as we move through the sort of risk-on, risk-off scenarios. And if you are only working with a fixed allocation environment in that space, you're going to run into trouble. But it goes back to Kirby's point. Can people actually get those timing?
So what does active mean to you in this environment? I mean, does it mean switching between asset classes? Does it mean, within the asset classes, how do you operate? What does it mean to you?
Both dynamics. It means that the traditional way of putting a purely passive strategy in place and saying, I've got 20 years to wait for this thing to sort of materialize, we could be waiting for Godot here. I mean, it's a highly problematic, because here's your real test between active and passive. The problem is passive will always cost you something. It's not free. It costs you something. The hope springs eternal around active is that it'll cover at least your costs, okay, that you just get something out of there for the costs. But the reality is in this environment here, where absolutely all the asset classes are at such a low level, that to even get to a point where we can properly retire, we're going to have to get something, some oomph in there, other than the asset classes that we've traditionally been able to rely on to get us to wherever we needed to.
For me, it comes down to two issues here, and it's things that the industry are difficult to kind of take on board. I think the first one is it's about asset allocation and being active as far as asset allocation is concerned. The second one is asset selection. Those are the two kind of big drivers for me. Now, you have to become a lot more active as far as these things are concerned, and you need to be able to understand them a lot better than what anybody else has to do. And I mean, I think the other thing for me is it again points for me to small investment teams and being able to make decisions for clients and make those decisions very, very, very quickly. Those become kind of important factors for me if you're going to be managing money within this environment until we go back into a normalized environment. And quite frankly, we can take on a lot of the tools that we've learned since the 1960s and 70s, because let's face it, that's where most of modern portfolio thinking really started happening. We could start taking on those tools, but those tools aren't going to help you today.
Sorry, go ahead.
I was just going to say, Roland's probably mortified listening to me because he's known that I always attacked active managers as not being able to demonstrate that skill. And so
I think there is a role for active management at the moment, but you have to be given this risk-on, risk-off environment. You have to be more top-down active than bottom-up
That's
active.
what I'm
I think for the last few years, stock picking...
Top-down means asset allocation.
yes.
But from a risk perspective, in other words, you're trying to actively manage risk, not trying to necessarily outperform. I think in the last few years, stock picking has been broken because you can be good at stock picking and just get wiped out by a government intervention. Whereas when we get back to that kind of hopefully normalized environment where we don't have government intervention, that's when stock picking is going to come back again. Everything's highly correlated at the moment. Stock picking doesn't work. You've got to be macro active. So I support the idea.
I would agree with that.
Well, on that note, we're going to have to leave it there.